Happy Monday. Welcome back, May 12th, final hour session. Low liquidity bull market. We had another big gap up today. Tail of the tape shows what a great day in the markets. And the reality is we had it all in the futures market. Basically, you had like a 3 a.m. burst in futures, and the market might have just gotten a little bit higher throughout the day. But this is the 5-minute chart on the SPY this morning. We had a monster gap up. I think we got up to about 3.02% from close Friday to today's open. So up 3%, pulled back a little bit, drifted a little bit higher. We should be showing about a 3% move in the markets today. So we've got S&P up 3.13, Nasdaq up about 3.8. I got the Qs up 3.92. The Dow's up 2.72. The Russell's up 3.6%. Volatility gets hit down to a fresh low. Let's go to the VIX here. VIX all the way down to 1860. Look, I mean, green on the day. We've cleared this March pullback level. That was your 2-week pullback in March, going into the trade uncertainty, going into Liberation Day. Liberation Day, obviously, the market broke. We have some vague optimism coming out of the U.S. and China talks this past weekend. I mentioned the futures, like look at the futures price action. I mentioned this a couple of times in my live sessions this morning. So, futures gapped higher. If we go to a smaller time frame here, you're going to see some notable gaps. Like the futures market doesn't gap very often. And that does make me a little bit concerned that this is going to be a spot for the futures market to find. This is going to be a spot for the futures market to find. This will be a spot for the futures market to find. Not ready yet. Obviously, I'm not calling the tops here, but I projected a low to high. Oops, let me change this back. I projected a low to high, higher low to higher high swing. We hit that. So if we start to see some price action turn south, I'm not sure what the catalyst is going to be this week. We've got inflation data coming on Tuesday for the U.S., projected to keep the CPI and core CPI the same as previous. I think the core was 2.8. If I'm not mistaken. Here's the Bloomberg Economic Calendar. Core CPI year over year was 2.8, forecasted to be the same tomorrow morning. And the CPI year over year, previous was 2.4, forecasted to be the same at 2.4. We'll see how those prints look tomorrow. Just be mindful of some potential gap fills. This yellow box is my symmetry right there. Low to high, higher low to higher high. That's why I have the blue line. So that symmetry has been achieved. Okay. Now I'm wondering if the market, after hitting symmetry, had this little move to the upside, if we're going to see some pullbacks. Again, I'm not selling this necessarily unless it's short-term futures trading, maybe some 0DT if we get some direction, but I would expect there to be some type of pullback off of a point scored by the bulls. Structure here all the way down, structure here. If this is just one big swing, there's a lot of levels back between 5,500 and 5,200 to hopefully entice some bulls to be waiting to buy a dip. I think what makes this challenging is, are we ever going to see a dip? And I hope that we do, for the fact that I want to participate in it just like everyone else. But I'm hoping we see something. Otherwise, this would be, I think, the more challenging market is just not participating in this whatsoever, because it just keeps gapping higher with no intraday price action. So it's good for daily profit play. We had another nice winner today. We've got a nice little hot streak going. We're 22 of our last 22 trades. And we've had very few losers. So we're still hitting around 90% over nearly 100 trades. Waterfall income, we got a trade up that's, I think it's positive 64% right now, 65% max credit. Put on a trade this morning as well. Hopefully looking to see the same thing. We're trying to get, 80, 85, 90% of the max credit. And yeah, so just got to be patient. I'm happy to celebrate some fresh highs for the year. All the way up here, I was sitting around 195K. All the way in here, I was sitting around 205K. Today, I'm up 225K. So highs for the year. Did take some lumps and scrapes during the decline. It did take some losses. I'm sure most traders should have taken losses if you weren't properly. I mean, I had hedges. I took hedge profits, but it was not easy to see the market dump 15% in 3 days. So I did take some lumps there. But back to where we are, and I still got some profits to show for it. Still a little bit of a tilt to the upside, so it should be looking good for more profits to come. All right. So what I'm looking for is, do we get a pullback? Can I start to participate in, maybe a sideways range if we get a sideways range, or is this going to be, a little pullback that offers up a dip, more structure, more all-time highs? We'll see. So the reason I use this thumbnail today, low liquidity bull market, is evidence is showing that we don't really have a lot of volume here. I mean, levels that I use every single day, current net position around 500. I mean, if we have a big, massive liquidity magnet, I'm usually seeing 1,000, 1,500, 2,000 net, which shows there's potentially billions of flows there. If I go into, let's go to unusual whales, get some levels in here as well. So there's a big gamma level around 580, which right now we're trading at 581. So this was on the day. If I go to my Periscope for some market exposure, same thing here. 5830 is a pretty big level on SPX. We go down and watch some levels. 5830 again on SPX, 5800 on SPX. We do have some interesting levels. 5800 here and 5700 here. But I'm curious going out to all expirations. Let me go. I can't get like more than one DTE, man. It's like what's a guy got to pay for? Anyway, I'll just be watching to see if there's any additional outlier levels. So there's a lot of space. We've got some drifts at 5,900. We got some levels at 5,800. We got some levels at 57. Day-to-day volume is still pretty light. I think what we're seeing right now is there's just a big absence of sellers in the market. Like there's no heavy selling right now. All the major puts that I see in the market that do expire on Friday, May 16th, the big OPEX cycle, a lot of those are, I think I got a screenshot here. We do have quite a bit. Let me see here. Took some screenshots this weekend on some content. So the news overnight was, U.S. and China were talking together. U.S. has scaled back the 145% tariff, so the 145% tariff down to 30%. China scaled back from a 125 down to 10. This is a 90-day pause. Market got super excited about this. It's vague optimism. We've kind of roughly inked the deal with the UK. That is the one country that the U.S. has a surplus with, so that's probably one of the easiest trade deals for us to do. Now with a little bit more talks in China, you can see the market still loving it. And if this causes more countries kind of realign, get in line with more deals, like this is probably all decent news that's going to roll in. But like it's 90 days. It's like, is this how this is going to keep going? It's like there's always going to be this window. It's like it's never here. There's never really the certainty of do we actually have trade deals, do we not have trade deals? But instead of we just keep these talks open, and then it's 90 days out, and then when it's within 30 days of that 90 days, do we kick it out again? This would feel a lot like Brexit. If anybody traded through Brexit like I did, 2016 was the summer referendum. Brexit was voted on. UK is going to leave the European Union, and the summer was crazy in the forex market. We saw it drag through 2016 into fall of 2016, into 2017, into 2018. It was years until the terms were actually agreed upon. We saw like 3 or 4 years of dragged out trade negotiations between the European Union and the UK. So I hope it's not that, since this is two major players like US and China. Anyway, still going. Let me find some data here from this weekend. Option volume, not a surprise here. We're sitting at record highs. We have, put call ratios, lots of volume coming in as far as options trading, but we have liquidity that's been leaving. You have like high option volume, you have lower purchases in the actual underlying asset. So liquidity is a little bit lighter. It's kind of driven by option flows. Some of the big levels that I'm seeing here to the downside, if I'm looking at the SPY, for example, we're trading up to 581 today, 582 right now. If we were to see like a nasty move to the downside, and again, this is all by this week. So by Friday's the May 16th expiration, that's an OPEX cycle. We'd have to have like a pretty dramatic move lower, because a lot of the puts that were in place here, a lot of the puts that were entered in the market when we first had our April 7th low, bit of a shakeout here through April 9th. A lot of puts were in place. So kind of, at the money puts were in place, and this is SPY, this is SPX, this is, options in general. A lot of those flows are still sitting here that traders that have been hedged basically are eating losses on all that put exposure. So if anything dramatic happens down here, we might see those puts actually maintain some type of value, but I think more than anything, it's probably just the repair trade that we've seen the market recover. Um, and I'm just wondering, like, maybe this is just kind of a typical boring OPEX cycle, which it can be, it might be. But the SPX is showing a little bit different gamma versus the SPY. Um, but anyway, a lot of it is lighter for this Friday. The major levels as far as puts and calls are at lower strikes. So even getting up into, the levels that we saw today, going back to, we'd have to have like a really violent move back below like 5,600, 5,500. So looking at the May 16th OPEX cycle, we're seeing a call to put ratio on indexes around 80-20. So you have like 80% of call option volume, 20% put option volume. ETFs is about 74-26. Individual stocks, you got about 71% calls, 29% puts. The S&P 500 just by itself is about 60-40. So definitely a heavily tilted, call skewed OPEX for Friday's expiration. Yep, and bigger option volume means bigger hedges, probably further out of the money as well. So anyway, as I see the structure right now, unless there is some major break of price action here, right? Like, going sideways is fine. Going slightly up higher is fine. Breaking back down and filling today's gap, maybe causes a bit of concern or pause, because I could see this level gets tested, this level gets broken, we pull back and we find a gap. I think a lot of traders would look at that and say, well, we just had from this low to this high, we just put in a really nice swing, right? This market from low to today's high is up around 21.5% off the bottom. Okay. So if we pull back and fill today's gap, is it going to continue to backfill, or is this going to be a dip to then offer up another buy trade? Right. So I could see a little pause right there if we come back and fill Friday's close, gap fill. The bears could certainly come swinging back down, at least in the interim, or at least see some profit taking because the market has been up 21%. You can dump some of these put positions, take some profits, hedge yourself a nice little winner. I'm sure that's what a lot of positions would show. If you were hedged in here to the downside with a low risk, high reward trade, and your overall portfolio is allowing you to de-risk and deleverage, that is a good sign. This goes back to the last month that I've been talking about. If this market offers a pullback, de-risk, deleverage. That's it. So, I was able to get to fresh highs for the year, portfolio-wise, as I was de-risking and deleveraging. I'm sitting now just under about 50% cash. Actually, that's going to be close. Do the numbers here. So 1.7. So about 53.7% of my portfolio is cash right now. And it was down to about 30, 35%. But since I've been closing out profits and taking a lot of the premiums off from selling in April, selling premium in April, taking a lot of those profits through the month of May. I did a lot of like May 16th and June 20th expirations. A lot of those profits were taken. So getting that cash back up to a decent level, I'm kind of ready to look for some fresh deployments. I talked to traders a lot about this last week. I am selling a lot of premium. I'm doing some covered calls. I'm doing some kind of boring strategies just in case the market is going to go sideways. Because even on the upside, this market, I think we can all agree here, the market's not really moving fast, right? Like a gap up today, it's like, oh, wow, the market's at 3%. Well, it happened in one candle, right? Like here is literally a 1 minute candle on the futures market. This is the entire move in 1 minute. So the entire move is at 3 a.m. this morning Eastern time, and then there's your 1 minute candle. We close right up here. So we are just talking a little tiny movement, about 0.68% slightly higher for the entire day. That's from 3 a.m. to now. Almost 12 hours later, this market has moved just over half of 1%. So, and I don't know how you trade that unless you looked at it like, well, I'm just going to get long into this anyway. And even if you didn't, I don't know what type of liquidity was sitting right there. If the market was to drop, I feel like you couldn't trade that. If the market rips, you're either in it already and you're getting the benefit of it, or the market dropped and you just can't trade that. So anyway, it's fine. Like a little skew in the portfolio, a little tilt helps me. Overall, getting the benefits of that run, but I just think I'm slightly cautious on how much higher, how much more momentum we actually have in this run. I think a pullback would make a lot of sense on the technical side. Getting 20+% off the lows, um, and this last little stretch here. If you go to the bottom that we had back in, this is April 21st. So from April 21st, we're talking about how many trading days? About 15 trading days. And outside of some sideways action last week, we've had mostly just green the entire time. So that's been like the low volume, the low liquidity bull market. That's the melt up that I'm talking about. I don't think that necessarily continues all the way to all time highs. Anything is happening. I'm not shorting this market. We could get to all time highs. It's not going to be a terrible thing. Um, but it would feel like anyone that's looking to participate, it's going to be difficult to participate. One thing that also puts a little bit of a dampening on this would be if you look at jobless claims. Okay, something to watch here. So here is couple like bigger things that I watch in my watch list would be if we have widening credit spreads, which after the market kind of broke, this would have been like a little bit of a flinch in the bond market during April 7th to the 11th. Bond market flinches. Trump and Trump and company, the administration backpedal. They put a 90-day pause in. The whole world reacts positively to that. And here we go, like liquidity is coming back and everything's kind of right back where we started. So that's a good sign as far as like bid ask prices are pretty tight, plenty of liquidity in the markets. Same thing here for LQD. You go to initial jobless claims. We have to zoom in here, but initial jobless claims, trying to zoom in. I mean, this trend isn't really concerning, right? I mean, if all of a sudden we start to see that initial jobless claims are rallying higher, then that's a huge concern. But it's not happening yet. So this is that whole idea of, is the U.S. going to have a recession? Unless we have job losses, there won't be a recession. There won't be. There could be a transitory recession. There could be a rolling recession. There could be things where other companies like corporate America admits like we already are in a recession. Main Street America admits that it's already feeling like it's in a recession. Things have not gotten better for most people for the last 5 years. So it certainly doesn't feel better. But as far as what the data shows, like, yeah, we don't have the job losses to show or justify a recession. Here's continued jobless claims. Same thing. You zoom in. Is this trend looking concerning? Not really. It's the same data point. This goes back into, October, I mean, even August, September of last year. Nothing crazy concerning about continued jobless claims. So until these start to make, noticeable trends higher, if we still have jobs, people are still working, economy's still resilient, earnings are still fine, buybacks are still at record highs, it's the soft landing that I suppose the economy is resilient enough to navigate, right? Go to the this shows unemployment rate at 3.9. We still have a print on non-farm. Non-farm is still printing like a 4.2 unemployment rate. Here is CPI, which is core CPI, so down to 2.6. That's the end of the month print. This is core PCE. We're looking at this week's CPI that prints tomorrow. 2.8 for the core and 2.4 for the year over year. So we'll see if that continues to push lower. As far as Trueflation, we have been trending lower since this would be December of last year. So December of last year, inflation pushing down. Let's see if our CPI, PPI data reflect that. Shelter has come down a decent amount as well. Energy prices, we cracked that 62 level on oil. So we could also see some pressures that continue to push inflation lower, which isn't a bad thing. One thing I'll be watching this week is after the Fed last week talked, we're still looking at a pause for June, and that probability has changed up to 92.1%. So initially, the Fed was expected to be cutting by May or June this year, and now they pushed back in May. Now they're looking to pause again in June, and here we go looking at July 30th. So we have obviously a lot more data coming in. This whole 90-day world, this 90-day tariff pause. If we're looking at like a July 9th, I think window. If that's roughly our pause window, it's like the Fed isn't going to do really anything until maybe end of July. One thing I will say that is probably going to impact the Fed right now. I mean, Powell's stance last week was pretty. I'm not going to say hawkish, but it was neutral at best. Like, I mean, if everyone's looking for a dovish Fed, they're not getting it. Not really hawkish, but certainly not looking to give the markets any inclination to think like the Fed's going to go crazy on cutting rates. If the Fed has to react to something, they can. And obviously reacting from 4.25% or 4.5% is a lot better than reacting at like 1% or 2%. So they do have some wiggle room to lower rates. Inflation is still sticky. Tariffs are inflationary. You can already see that there are some prices that are going up. I don't know how prices they're just going to come down. Even if we blanket the world with 10% tariffs and the market loves it, that was what the market was prepared for. Well, we obviously shocked the market a lot by throwing out blanket tariffs to the entire world, and then we backpedal it and say, probably going to end up somewhere around 10% tariffs. Fine, whatever. But it's still going to make things more expensive. If there is supply chain disruption, we've had, tariffs in Hollywood, we have tariffs in pharma. We're not done. Like, Trump isn't done, you know? So the Fed is kind of sitting on the sidelines being a lot more observant and a lot more reactionary, as they always are reactionary. Usually that's why they get so much flack and everyone hates the Fed so much, is because they don't proactively do anything. But it's really not their job. So if you want to criticize the Fed for being reactive, well, they've got us pretty much out of every major financial crisis that we've seen. But it's just happening more and more frequently. Nobody really remembers the dip in 2023 was a regional bank crisis, but the Fed backstopped that. We all remember COVID. The Fed backstopped that. 2018, Fed backstopped that. It was in 2019 early on. 2015, 2016, fiscal policy. 2008, backstopped. 2001, backstopped. 80s, backstopped. 90s, backstopped. So they don't have to be proactive to anything. If something breaks, the Fed is usually there to at least absorb and react and fix. But that was the question going into this year is, if Trump is going to drive the market down 20%, the Fed's backstop isn't 20%. I really thought the Fed put would have been closer to like 30, 35%. We're talking like straight up recession. We're talking, really, really concerning data that's hitting the markets really, really quickly. Well, that didn't happen, right? Market absorbed that correction pretty nicely. Here we are reflexively going higher. And, I think this is fine. Look, we don't have to get to all-time highs anytime soon. We don't have to revisit lows anytime soon. We can have, and actually, let me drag one thing out here. If I go from high to low, I was a bit surprised that the market did get above the 70% handle. What I've seen, I actually did I published a research report on this a while back, but it was the anatomy of a wedge. If you see a swing and we go back 70%, a lot of times that swing ends up yielding a wedge. So if you go from high to low and you pull back about 70%, usually that becomes a 70% pullback here, becomes a 70% pullback here, right? You take each individual swing. So you have this swing, pulls back 70%. You take this swing, pulls back 70%. Take this swing, pulls back, and it goes on until the market has to get to a point where it has to do something different. It has to eventually break and go somewhere, up or down, right? So that's kind of where we're at. Are we going to see, the market pausing here and then pulling back? If it pulls back, we could still make a higher low. This market kind of shake out a lot of traders, not really give us any direction. I think that's a perfect environment to sell covered calls, not have to get crazy directional, just trade good strategies, pull in some income. The hardest part right now is if this thing keeps going up, I feel like, man, I really missed out, because I was aggressive when I felt like it was appropriate. I was aggressive when this market was down. I was aggressive when we had our first little dip and pullback. I was hedged to the downside just in case we needed it. But now it's, the profits are in. Like, I've enjoyed most of the profits, and there's still some more to it. But I just think if we don't take out highs, we don't take out lows, and we just kind of go into a sideways range, that would make some sense to me. Just get a little bit more of the indecision kind of wave cycle that the market might be giving us. If we obviously get back to all-time highs, it's fine. I measured cup and handle symmetry. It wouldn't surprise me. Any dips here, if people are like super eager to buy, well, a dip here that looks good, maybe get a gap fill, and it's going to be a buy the dip. I'm not that excited about buying the dip at 5,700. I'm a little bit more excited about a dip around 55, a little bit more excited around the dip around 53, and really excited around a 5,100 if that even happens. But I'd say right now my favorite area to watch would be probably somewhere between like 55 and 5,300. Okay. Now I say that, but realistically, it's like, is the market going to do something to pull back 4%? I don't know what that catalyst is. Is the market going to do something to pull back 8%? I mean, if we have an 8% pullback, that's going to scare the crap out of everybody again. Anything can happen. But I want to be ready for, technical levels to pull back and give some gap fills and everything that's been created these last few weeks. Okay. Pharmaceuticals got a boost today. Yeah, that's good. I saw it was some highlight over the weekend that between like 30% to 80% lower prices on pharma. So, Pfizer got a little bit of a bump today. They announced a dividend. Here's my breaking news on Pfizer. Reshape how Americans pay for drugs. Why is it bad for pharma stocks? Spared worst case drug pricing scenario for now, says Wall Street Journal. Let's see what this says. Monday executive order could restructure how Americans buy prescription drugs, pushing them away from insurers and pharmacy benefit managers towards cash pay options. Okay, push drug makers to sell prescription drugs at low prices directly to patients. Well, I mean, why the hell couldn't we do that in the first place? Blame pharmacy benefit managers for high drug prices. Big pharma jumped. So you got Pfizer shares up 3%, Eli Lilly up 2.8, Merck up 6.3, biotech. This is up 4%. Okay. And this is what I'm hearing a lot from this current administration. They're words on a page, vague optimism, right? There's not a lot of substantiated data here. There's not a lot of proof. There's not a lot of ink just to talk, just to comment, just to tweet, just a headline, right? So anyway, falling hard on Monday. So insurance giants, Cigna falling down, CVS down, United Health Group off 0.4%. I put in a ratio spread on United Health Group. That stock's been beat up like crazy since their CEO was murdered. But I took a stab at it. Let's see. I mean, it'd be nice to have some cheaper drugs for everyone, especially with this baby boomer generation that needs it the most. So we go on. Price reductions across the board makes sense. Okay, him and hers up. I mean, this one continues to run pretty hot. Wow. So diagonal spread took some profit. Ratio spreads up most of the profit. Let me check on AMD. I think I had profit on both of these today. HIMS and AMD. Let me double check this one. So AMD up around 90% max credit. I think I'm just going to go ahead and take the profit here. Just going to take the winner, grab 80 bucks. Let me close this one down if it's hopefully trading for like less than 10 cents. So 9-cent debit, hopefully it'll close out for 10 cents or less. 9-cent debit got closed. All right, I'm going to close AMD. This is in my Project Options Edge course. So I'm going to close this one down for 9 cents. Closing for 9 cents. So that is a ratio. Closing. All right, just give me a second to close these down. Okay, if it doesn't close, I'm just going to let the order pend. That one closed at 9. Let that one pend at 9. That's really weird. Close me down. Okay, this one, no exposure. This one. There we go. Pending at 9 cents. Close at 9 cents. Pending at 9 cents. Well, it'd be different if I took a shot at it, huh? That'd be the choice of words you're looking for. All right, no exposure there, no exposure there, no exposure there. All right, so I've got pending orders to close. I did get most of those filled, so that did fill at 9 cents. This will be your project options edge. This will be a closeout on AMD. So looking here for AMD. So 88 cents credit, closed, 0.9 debit, keeping about 89% of that profit. So let's see here. 09 minus 88, keeping 89.7% max credit. Closing that trade. Okay, the other ones can close out as well. So that's good on AMD. HIMS, this ratio spread is up around 86%. Also another one that's out for a while. I mean, up $130 max credit. I'm up 112. I have 250 days left in the trade. It doesn't do me any good to sit here and wait for 250 days to grab an extra 20 bucks, $18. So I think I'm just going to close this one. If we get to HIMS, I mean, a dip or a pullback would be great. I wouldn't mind. I mean, this has been a crazy volatile stock. Obviously, to get to the highs, growth stocks were in question. But since this is a bit of a, pharma play as well, plus growth, I mean, you kind of get the best of both worlds for now. If this one offers up a decent dip or a pullback, I might look at some additional ratio spreads. So I think it's best if I just take the profit on this one now, take the 112% or $112 and just let it go. So that was a trade for 130. That's trading for about 14 cents. See if I can get out of here for 15 or better. Easy peasy. All right, so HIMS. Go to HIMS. This is the ratio spread. So the entry closed at 15-cent debit, keeping, so we're at 115, keeping 88.4% of max credit. All right, so closing out HIMS for profit. That's good. Get some buy power back. Same thing here. Close those diagonal spreads. There we go. There's my ratio spread. Close this one for, see if we get 15 out of this again. Filled at 14. Filled at 13. This is all good pricing actually. Filled at 13. Okay. Close at 13. So closing all these for profit. Good. Work my way through the list here. Okay. This one. Buy one, sell two. Surprised let me do that trade actually, that cash account. This one, $1.30. That was showing, I think I got out here with 12 cents maybe. 12 cents, even better, Phil. Okay, this one's a new account, so no HIMs. Okay, so those are closed out. Let's go to update. Okay, so that trade on AMD is going to be credit closing for 0.09 debit. Keeping 89 max credit. Okay. So HIM's closed up, AMD closed up. Grabbing a few more bucks. Still have some options to watch for this week. Here's my DTE. I've got some covered calls on Snap. We're actually getting a rally. I've got it called away at $10 and $10.50. I'm going to continue to sell calls against it. I want to see if this price will appreciate, so I'm going to hold Snap a little bit longer. IBIT, I've got some covered calls this week that are expiring at 62. I don't know if I'm going to cover it again. This is a play on Bitcoin. So if we get up to highs, we start to fade. I might sell some covered calls. If we break all-time highs in Bitcoin with some momentum, I want the price appreciation on Bitcoin. So I'm not really looking to get out of the trade. I don't know if we're going to get to 62 this week. According to what I see here, 62 is still an out-of-the-money move. That'd be about a 10 delta. So there's only about a 10% chance that this stock gets called away. And I would probably end up rolling it out farther anyway if that was the case. So should be good on that one to just let it expire for full credit on the covered call. SLV have some 35 calls. I might look out a little bit further and sell some calls on silver. I mean, overall, I like my position on silver. Baidu got some calls at 95. I'm going to see what it's worth. That's one stock. If we have this U.S. and China talk improving, I think that Baba and Baidu can still both perform pretty well. I don't really want to get in the way of them too much. I'd like to see some price appreciation on this one. So I'm hanging on to some shares. I'd like to see if Baidu can get back above $100. JD, I have covered calls this week at 40. We do have earnings this week as well. So I'll see if earnings is positive or negative. If it gets called away at $40, that's okay. My break even on JD, my break even is 34.77. 34.77, get called away at 40. 1,500 shares. I make about 7,800, almost 7,850 on that if it gets called away this week. But we've got to get back about $40. Expiration this week. Upside potential. Expected move is around 38.50. So we'd have to have a pretty big move to the upside to see this thing sprint above 40. If it does, that's fine. I might roll it out another week just to collect the income on it if it's looking good momentum wise. But otherwise, probably just going to get the covered call for full credit. It's up about 95%. Pfizer still running, have some shares, have a diagonal spread, the 20 by 29. I'm down. I actually downed quite a bit on Pfizer. This is kind of this is about a year-long project right now because I got into the trade early this year. I went out a year and a half. This is a summer of 2026 expiration on my long side, and I'm selling premium against it, trying to decrease. I only pulled in about 24 cents. It expires this week, so I'll have another trade where I've got to do some covered calls. So let me write this down. Covered calls on IBIT, on Snap, on Pfizer, and on SLV. So I'll revisit, adding covered calls to those to generate the income. I want to make it worth my time. I don't want to just throw a covered call for the sake of doing it. I want to see if I can actually get some legitimate premium from it. CB, this one's going to be up in profit. This is going to be full expiration. CB should be a good winner this week. I took the same trade with CB. That's Chubb. That's insurance play. Same thing with Progressive. MasterCard, Visa, Amex. I was kind of in the same space, dabbling in those April lows. This one's up about 99%. I'm not going to close it. It's just going to expire. It's like if I close it now, I'm gonna forfeit 35 cents a contract. I'm not going to do that. I'm just going to let it expire. As long as we stay above 215, I'm making $200, $200, and that'll be by the end of Friday. So that should be good for a winner. Shopify, it's break even right now. I'm hoping that a little bit more upside or a retreat. It's like I'm not excited about taking a tiny little $5 profit, so I'm going to wait. I paid 97 cents. I'm trying to make $2 on the trade. If we stay above 106, or we stay at this point we might as well stay above 106. If we stay above 106, we'll make some dollars. We'll make almost 100% on the trade, actually over 100% of the trade. If we get back where we are right now, 105.30, I'm still up on the trade technically about 30 to 40 cents. So with a little bit more time, this trade could work out to still be like a 30 to 40% winner. But I need to stay where it is. DraftKings, just about break even right now. I need this to get back above 39.50. UNG, I have a diagonal spread. We did fade a little bit. I've got an expiration for next week. I'm up on the position. I'm not looking to play games with gas, oil, treasuries. It's like I did some aggressive rolls last week in order to lower my cost basis and try to get these called away a little bit sooner. So there's just some upcoming expirations. Also, I did a roll today on IWM. I did a roll today on Tesla. We're trading at 581 in the SPY. I do have a covered call at the end of the month at 590. If that does get called away, I'm going to continue to roll this. So let me see. Let me look at this right now. So to do a quick roll, if I go out to June 6th, 590, see if I go out a little bit further in time. June 13th, June 20th, June 27th. All right, I'm going to go out to the end of the month and roll this call. I'm going to get $4.90 to roll this call. If it gets called away, I'm totally fine with that. Let me find my SPY price there. SPY. Okay. So 590 covered call. There it is. So I have a break even right now at 5. Add a new collar. Closed out the collar. New break even is 564. My break even is 562. So if I can lower my cost basis another $4.90, that brings me down to 557. Get it called away at 590. 557, 590. I get, $3,300 on a repair trade. This was all part of my waterfall income. This was one chunk of shares that I kept as one of my master classes, which was repairing trades or advanced trade management. I'm going to take this trade and roll this thing. See if it'll give me 590 for it. The bid is 487. So let me see if I can get a little bit, maybe 491. Try 492 for this one. So I'm rolling it out by another 30 days. 492 not filling, 491. Come on. Okay, just got filled at 490. So rolled to 430, took credit, 584, closed out a collar, 579, new covered call, 576, new collar. Yeah, so I'm going to lower this thing by $4.90. I'm actually pretty happy about this. It's taken some repair. Actually rolled out to June 30th expiration, 590. Sell call for $4.90 credit. So that new break even would be $562. So 557.32. Okay. So that gets called away at 590. Oops. 557.32 minus 590. That is on 100 shares. That'd be 32.68. It's not bad. I mean, I lost on the trade. I think I lost between 3 trades that I took losses on in December of last year. I lost around $1,200. So if I walk away with $3,300, I lost $1,200 back in December. I'm making $2,100 and washing away those losses and walking ahead almost $2,000. So, or $2,100. That's not a bad repair. So that is SPY. What else do I have expiration wise? These are all closer near-term expirations. TLT trading at 86. I actually lowered my time in the trade and lowered my strike in the trade. So it's an 89 call on a diagonal spread. There is a way I could still get this one. Like if we get a surge up above $89, $90 on TLT, that could be interesting. But the diagonal spread, the way it sets up right now, it's like we're still turning lower on bonds and we're still turning higher on yields. So 2-year yield is up, 10-year yield is up, 20-year yield is up. This is what I think puts the Fed in a corner where they can't really cut rates as aggressively as everyone wants them to. I also think that the bond market is trying to say, hey, look, you want us to take on your debt, pay us more money. Like term premium, risk premium is higher, and this is what bond traders are willing to accept. They need more premium. So yields are not coming down, and this is the kind of opposite effect where Fed cut rates right here, bond market went up, right? If the Fed's going to start cutting rates again and we get the opposite reaction, look, the Fed is planning on somewhere between a 0.5 to 1% cut by the end of the year. If it's only 2 cuts by the end of the year, they're probably going to do 25 and 25 basis points. If they do 3 cuts, we're probably talking 0.75, right? So this would be like 3 to 4 cuts between about 0.75 and 1%. Look, if this basis points to basis points does the opposite, meaning like if the Fed cuts by 50 basis points and this goes up 50 basis points, or the Fed cuts by 75 basis points, this goes up 75 basis points, that is not a good sign. That is the bond market saying, look, we want to be paid more to own this debt because now this debt is getting a lot riskier. As the fiscal cliff is coming, as the deficits continue to widen and grow, none of this is good. So anyway, Bitcoin seeing a pause, we build in support. I mean, I've talked about the structure on Bitcoin the last couple of weeks. I mean, if we're going to get Bitcoin to go higher, I mean, I'm fine with this pause. I think that we have some inefficiencies along the way. If Bitcoin pulls back, that's a logical spot, and so is this window right here. So if you're a buyer, pull back into that dip or pull back into this structure anywhere. I mean, I'd say like 90, 92 to 87 looks like a pretty good spot to, buy back in. If we get to all-time highs, that's fine. I could see this, faking out the bulls, coming back down. I don't think we get to all-time highs in Bitcoin without the stock market going with it. I really don't. So if we're going to see the stock market, have this big rally off the April 7th bottom, but then it starts to turn south, I think that Bitcoin turns south with it. So I hope there's an opportunity to kind of get back into Bitcoin on some dips. If we come back and revisit the lows, that could be really attractive, as could be that. And the accumulation of buying in this area, getting back to these highs and going higher, that capital appreciation would be well worth the buying dip. So I do like Bitcoin for that pullback. Okay, gold and silver. I still like both. Silver is pausing. Gold is pausing. This could be a consolidation pause for gold, which is fine. If we pull back deeper, I'm still eager to buy, anywhere between the 100 and the 200 moving average. Silver, bit more of a pause. Still well supported at 29, well supported at 26. Breakout levels would be 35. My SLV positions, I've got covered calls up here at the highs at 33. So I have a 35 covered or 33 covered call and a 35 covered call. I'm not really looking to get this covered unless price is going higher. Let me see something here on this workspace. Let me go to SLV. Yeah, I mean, I could see silver, one of two things. I could see silver coming back down into 29 support. That'd be on XAG, but on SLV about 27, or going back to break these resistance levels. So what I don't want to do is I don't want to call the top and take this really low premium covered call when the reality is I like silver enough that if this goes higher, I don't want to just add a covered call now when volatility is still really low, right? I want to see if the premiums are increasing because direction's going my way. Then we get to 32 or 33 on SLV, and I can settle at 35, 36, or 37, which would be maybe like a 10 delta or a 20 delta covered call. I want it to be out of the way. I want it to be where price is going to have to appreciate enough to get me called away, as opposed to I do it now, then price starts to move, and I just sit on a terrible covered call position, right? Like it may not be called away, but I don't think I'm going to get the premium that I want. Let's see. Roll says I went into Ethereum before this pump since Bitcoin solid decision. I mean, it's fine. Ethereum's come back in a nice way. I mean, that's a nice rip on Ethereum. So there's definitely a catch up trade here. I like Bitcoin more. I mean, we're up 45% in the last like 4 trading days on Ethereum. That's a mega surge right there. But the whole time that Bitcoin has been going up and steady with way less volatility, I mean, Ethereum's down 67%. So I don't know, who was enjoying this decline in Ethereum, because I certainly wasn't. So I didn't participate. I mean, my Ethereum surge last year was this consolidation, this rip. I did some 1-1-1s and ratio spreads, and so by the time this was here, I was taking some profit. Even on pullbacks, I was taking some profit, which I'm glad I did, because we started to get a little bit riskier there towards the end of the year in December, right? And so now that it's breaking, look, I'm sure in the crypto space, there's people that are looking at this like Ethereum's got all this room to catch up. I'm sure that it does, but I still like Bitcoin better. So I'm not really in a rotation mode. I'm more like use Bitcoin as it is. This is a Web 3.0. This is AI. This is the future. This is the digital system, decentralized system. There's a lot of things that it stands for. And I think this is kind of your S&P of the digital world. So I'm going to stick with Bitcoin. IBIT is very liquid. It's easy to trade. It's cheap. I can own the shares. I can sell options. I can buy options. Ethereum, I've got a little bit, but it's just less liquid. So, like I said, I think the catch-up trade is understandable. Getting back to highs again would be exciting, but I'm less excited about Ethereum versus what the bigger picture could hold if Bitcoin, even if it accumulates here, if we go sideways and sideways, but let's say medium to long term, we break out to fresh highs. I mean, that's a measurement to 130. I mean, I'd be excited at 130, right? Price appreciation, don't get in the way. I'm not going to sell covered calls. I will sell covered calls here, though. If price is up here on Bitcoin, then I'll sell covered calls. But I don't want to like call the top and have price surge through this level and I get my covered call, taken out. I let go of the shares and price just ripping higher. So, I'll try to time it. That's all. Okay. That should do it for today. I mean, let's look at the heat map. So we had about 74% of stocks advancing, lots of green across the board. What didn't do well today? Let's find out. Telecom didn't do super awesome. Utilities were down today, actually all red in utilities for the most part. Defenses were down as well. PM is down, MO is down, Coca-Cola down. But, tech, broader market looked pretty good. How about the world? Mixed in Canada. Europe looks pretty strong. China, very strong. China, Japan, India, Taiwan, Singapore, Australia, a lot of green. So Eurozone, a little bit mixed. DAX actually hit fresh all-time highs. Today faded a little bit off those highs. But, yeah. US, pretty good. So let's check one more thing. S5FI. How many stocks are above the 50-day? 61% of stocks above the 50-day. How many of those stocks are above the 200-day? 42%. So we still have a lot of stocks in between the 50 and the 200. They're greater than the 50 right now, but they're still less than the 200. Okay. Here's an example of a timing indicator for me. If we have stocks that are showing greater than 50 moving average, but less than the 200, all it takes is price to come back up and find that 200 moving average and then fail, right? So if that happens, like there's still a ceiling in these current markets. Look, if I'm wrong and this thing just goes all the way back up to highs again, then sure, everything's overbought if we get up here. But there's still a ceiling to climb. There's still resistance ahead, and based on this recent run, especially in the futures market, we're probably going to have some gaps filling. I don't know what the news is that's going to cause the market to turn. It could be CPI this week as an excuse. It could be all after hours. Who knows? But that gap fill is likely. This is a big inefficiency, so that's likely. and this is another big gap fill in the futures market, that's likely. So, I mean, look, celebrate if the market's going to go to all-time highs. Awesome. Congratulations, right? Less pain in the market. But I think a pullback would be a dip opportunity. I'm probably not excited about buying that dip, but certainly more into this area, buying this dip, just give us something. Like give us a structure trade, give us a pattern trade. So this left shoulder, that's what I'd at least like to see. Can we pull back into like a right shoulder, break a trend line, get on the right-hand side of it, see if we can spot a pattern, then we get above the neckline, then we can measure move. So, I mean, there is a time and a place to be aggressive. Right now with this market melting up higher, futures gaps, news that's announced that we have no control over, 3-minute candle or 3 am candles that you have no control over. I'm just gonna enjoy the melt up while it keeps happening. But I think a pullback is inevitable. I think a pullback would offer up some better buying opportunities. So if we want to see the real broad market participate in a higher low, I think that's where it has to be. Then we can get more excited about that move. And again, this is all good stuff, because if we are going to measure this out, let's just take this as a head and shoulders. Okay, I hit my symmetry, that's done. Now I'm going to take a new swing. So let's go from this low to now this high. Let's say that this is our new high. This is our swing. Okay. So there's our swing with today's candle being like, maybe we mark the high this week. All right. So let's say we get a pullback. Well, there's two ways that I'll measure this. If we get a pullback towards, left shoulder area, this is all like hypothetical, but let's say about 55.24. And I'm going to clone this and project a move where we could see realistically, we could see a symmetry swing towards around 65.50 on the S&P. What's even more exciting is we could also see a breakout trade where it breaks it as a head and shoulders trade, and we have two spots. We have symmetry and we have head and shoulders projection. So, I mean, this is, maybe it's medium term. I'm not going to put a timeline here, but I would say if this structure is held, I could see a 6,500 to 6,900 S&P. And it's possible that we get there later this year. It's possible. That would be an incredible amount of volatility in a given year, though. I mean, the average volatility in the markets is about 13 to 15%, top to bottom. And usually the market squeaks out about an 8%, 10% gain. That's average. Okay. So if we had this move, we're talking like a 40, 50% rally off of the April low. So I don't know how quickly this is going to happen, but from that low to symmetry, that'd be a 36% move. That would be a 43% move. I mean, and what's funny is everyone's going to look at this and say, net on the year, this is where the year started. We had a huge drawdown, right? Peak to trough is 21% of the S&P, 28% Nasdaq. But from the recent all-time highs, the market started about right here, right? It was up, I think, at the most this year about 4%. So we're looking at a year that maybe from this point gets us up to around 7.76% higher from the start of the year. Despite the 20% pullback, right? You still have a reflexive market. We push up and it's net on the year, 8%. Right? If we get a little bit lucky, maybe it goes up to, that'd be maybe a double-digit gain. So we start in here, we get to that head and shoulders projection, we're about 14% for the year. Like that's right in line with like historical averages. Nothing crazy exciting, nothing crazy impressive. Hey, congratulations, the market's up 7% for the year. Well, given the fact that it was down 21%, the courage to buy that is where a lot of those gains are sitting. And you probably know the statistic here, but if you miss out on the worst days of the market, you tend to miss out on the best days of the market. And that's literally what April 7th through the 11th was all about. We had one of the worst days, ever in the markets. We had one of the worst and nasty sell-offs ever in the market. We had COVID type pricing. We had like systemic risk type pricing. And then, literally within 2 or 3 days later, the market rips up and makes some of the biggest, one of the biggest single day swings we've seen ever. So that's the craziness about the market. So anyway, just doing some projections. I'll keep talking through this a little bit. I'm going to project this one out. So horizontal ray there and there. And I'll just label these so I don't have to keep these boxes on my charts. But I'm going to label this one head and shoulders symmetry. So this would be a crown symmetry. And this would be a head and shoulders projection. There. So, if we are going to make all-time highs, I think there's room to run until we get to like 65 or 6,900. And this is why I'm not going to sit here and call the top, right? So I hope that we have a chance to participate in some type of pullback, and then we can project a symmetry swing. We can use this as a high, but that to me would be a spot to be looking to protect some major profits. Do I think the DAX will follow? I don't know, man. The DAX is behaving very differently. I mean, I think the DAX, after hitting all-time highs again, I'd love to see the DAX do something similar where we have some pullback in here. So from this low to this high, I mean, if the DAX could settle back in and consolidate, this could be a nice way to participate in some all-time highs. I hope it offers something. I mean, my gosh, this is just, it's like, how difficult is it to, number one, I mean, this was so much lower than the 200-day moving average, right? I mean, this thing dropped, I almost want to say 10% below. We were 9% below the 200-day moving average. So, I mean, I don't know if that's the top, but if we go from low to high, I think anybody looking to buy the dip would love to see something at like a 23%, 38%, 50%. Like, give us something to then project this thing to go higher. Because if it keeps going higher and higher and higher and higher, that's a tough market to buy. Unless it's just forced dollar cost averaging, forced allocation. Like, I'm a trader. I want to buy low. If I don't get my opportunity, like, I'm not going to trade the DAX. So, I mean, my credits on FEZ are fine. But if I don't get the trade that I want, I'm not going to take it. But I could see similar structure. FTSE kind of similar. Could we do the same thing here? If this gets back up to highs again, pull back, consolidate a little bit in here, but then all-time highs. So, I mean, structure looks better. Brazil, I'm liking Brazil above the 200-day moving average. I'm liking Latin America above the 200-day moving average. I do have some exposure in those ETFs as well. Mags, little cautious on Mags just because we pulled back towards the 61% pullback. So if this hits resistance in here, then I'm looking for maybe a gap fill. I still like Mags like medium to long term, but I participated down here, took my profit. I did mostly individual sell premiums. So I sold Apple, ratio spreads, Amazon, Google, Microsoft, Meta, Tesla, lots of ratio spreads, lots of naked puts. Took a lot of profit in the last 45 to 60 days. So now I wait. Are you also concerned with straight up moving the indexes? If we shoot straight up, I think there'll be a strong reaction later. Of course. I mean, this is why I said this was like last week. I think I did this was one of my thumbnails. This is one of my thumbnails from last week. If we keep going higher, okay, if we keep going higher and it looks like there's no pullback, then we're going to get a bubble. And that bubble could be, out in the future. That could be 12 months from now. That could be, whatever. I don't know. That's the dumbest thing to call a timing. Timing the top. But I do think we're going to go into the same bubble that we've seen since the last, 7-8 years. So 2018 to now has been bubble after bubble after boom after bust after boom after bust. And it would be probably something very similar. So we get to a ridiculous top again. If the market blows off 6,200 and we get to 65, 66, or 7,000, it's going to get a little long in the tooth. I'll check my technicals. I'll put on some seasonal timing, but I don't know. I mean, I'll hedge for some asymmetry, but it's like it's so hard. It's so hard to be like super bearish when these markets are this reflexive. But I think if we keep going higher, we don't offer dips and pullbacks, then I think we're just going to get a bubble again. So and that that kind of nonsensical boom and bust cycle will continue, and that is going to be very challenging to see just constantly. Year after year, it's like we're up 40%, down 50%, we're up 20%, down 10. It's like lots and lots of shakeouts. And if you're not, look, if you're long-term oriented, it doesn't really look like anything but noise, but it's really stressful if you're paying attention. If you're not paying attention, then it doesn't matter because the market's just trying to make all-time highs. But if you are paying attention, there's ways to time these moves where, a 5% correction, 10% correction are good buying opportunities. A 20% correction is a great buying opportunity. It's not perfect, right? We had a 20 plus percent correction in 2018. We had it multiple times in 2018 to 2019, 20 plus percent off the highs. And then 2020, we had a 30 plus percent correction. 2022, we had a 25 to 35% correction. We only had a 10% correction last year. That was our biggest dip from July to August, was a 10% dip in the markets. This year, we had a 20% correction. So we've had like 7 big corrections in 7 or 8 years. And I feel like that path and that pattern is likely to continue to repeat. Thoughts on dollar yen? I mean, yeah, it's had a pretty big move. I mean, I think if you're late to this trade, I would not participate in this too much. I mean, look, man, I talked about buying this dollar yen literally at the same low because it was such a low risk trade. And even when you had your first pullback and you had a pause right there, it's like, look, you can take a swing trade stop loss below and trade this thing up to 140 at 149. To me, it's already profit. So if you're in this thing long, I would be out for profit or at least moving stop losses. If it goes higher, great, but I don't really like this. Running right back into support becoming resistance, hitting the 200 moving average in the ribbon resistance. So I wouldn't try to chase this thing higher, right? Instead, it's like, well, if you had the courage to follow this thing at support, you now have 800 pips of upside. If you didn't get that trade, I wouldn't chase this thing higher. I would say you missed it. So, if this comes all the way back up to these highs, then obviously I'm looking at resistance here, and I'm certainly looking at resistance here. But don't call the top without breaking structure. So, anyway. Okay, I think I'll let you go for today, and we'll come back and do it again tomorrow. Okay, thanks everybody. Have a good rest of the day. I'll see you soon for the next final hour. Thanks, bye.